Hello everyone, and welcome back to Financial Accounting. In this second part of Chapter 2, I'm going to continue our discussion about transaction approach. And here I'm going to start talking about something very important in accounting, which is called the double entry accounting system. So the double entry accounting system is in all businesses. And this system is based on the accounting equation. And it requires a couple of things. The first thing is that every business transaction to be recorded in at least two accounts. So this is very important for us to know that every single transaction that we record in accounting has to affect at least two accounts. It could be more, but it can never affect one account. So for example, if I paid cash is one of those accounts, but I need to know what is the other account that this cash was paid for. Did I pay it for salaries? And that, in this case, the other account would be salaries expense. If I paid cash in order to acquire new supplies, then the second account is supplies, and so on. So every transaction that we record in accounting has to affect at least two accounts. The other requirement, or the second condition, is that the total debits recorded for each transaction should always equal the total credits. And that would keep something very important, which is the accounting equation balanced. So in order to keep the accounting equation balanced, we have to have whatever is recorded on the debit equal or matches what is recorded on the credit side. So debits should always be equal to credits. And that the second condition that's needed for the double entry accounting system. So the double entry accounting system has specific rules of debit and credit for recording transactions in the account. And let's see these rules. So as you can see here, we have like the accounting equation where we have assets equal liabilities plus stockholders' equity. Remember, I told you last week, this is considered to be the foundation of accounting. This is very important for accounting. I want you to know this by heart. Assets equal liabilities plus stockholders' equity. So basically, the resources of a business should equal two things. The stockholders' equity, which are the owner's right in these assets, plus the liabilities, which is what we owe to others towards these assets. So it has to be always balanced. So for assets, and we use that in our presentation of the T account, and here we have a small T account that you can see. The debit side is the side where we record any kind of increase. And the credit side is the side where we record any kind of decrease. Okay? And why is that? Because you can see here, if I can have an imaginary line that separates assets from liabilities and equity, or split this accounting equation into two parts, where assets is the left-hand side, we can say that assets like the debit side, the left-hand side. And this is why this is the side where we should record any kind of increase. On the other side, liabilities and stockholders' equity, you see that the credit side for them, and we have here two little T accounts, the right-hand side of them is, or the credit side, is the side where we record any kind of increase in these accounts. So if I have more liabilities, I record them on the credit side of the liability account. So let's say an example of a liability is accounts payable. So if I want to record an increase in accounts payable, I would record it on the credit side of that account. Same thing for stockholders' equity, like common stock. If I have more common stock issued, then I record the increase on the credit side. And then unlike assets, they don't like the debit side. So this is where we record any kind of decrease. So when we have a decrease in liabilities or stockholders' equity, we record them on the debit side. And that's one of the very important things when it comes to applying the concept of debit and credit to the accounting equation. I want you to remember that assets, their favorite side is the debit side, and this is where they record the increases. Liabilities on stockholders' equity, their preferred or their favorite side is the credit side, the right-hand side, and this is where we record the increases. And we typically record the increase where the account has a preference. So if it's an asset, they prefer the debit side, we record the increase on the debit side. For liabilities and equity, they like the credit side, so we record the increase on the credit side. And the opposite when it comes to decreases. So if I want to decrease an asset, I record it on the credit side. If I want to decrease a liability or a stockholder's equity, we record it on the debit side. So the debit and credit rules for income statement accounts are based on the relationship with stockholders' equity. So if we want to see how revenues and expenses are affected with the debit and credit, think about stockholders' equity, because revenues and expenses, they're somehow related to stockholders' equity. We call these the income statement accounts. Remember, revenues and expenses. Revenues increase stockholders' equity, and that's why they have the exact same nature as equity. And you can look here at revenue. The side where we record any increase in revenue is the credit side, which is, if I go back to the previous slide, very similar to stockholders' equity, where the credit side is the side where it increases. Expenses, on the other side, this is the opposite of stockholders' equity. It has an opposite nature. It decreases the equity. So that's why the debit side is the side where we have the increase of an account. So if I want to increase an expense, if I want to record an expense, I'll record it on the debit side of the expense account. So let's compare that to stockholders' equity. So you see here, debit used to be the decrease, but because expenses, they have the opposite nature, or they have, like we know that expenses reduce stockholders' equity, so it works in the opposite direction. So you can see here for expenses, debit are recorded like it's the left-hand side where we record the increase, and credit is where we record the decrease. So I want you to remember this statement. The debit and credit rules for income statement accounts, which are the revenues and expenses, are based on the relationship with stockholders' equity. So revenues, they have exact same relationship as stockholders' equity. Expenses, they have opposite relationship to stockholders' equity. The last account is dividends. And dividends works opposite to stockholders' equity too. Why? Because when the company distributes dividends to the shareholders, it actually reduces their equity. So that's why we see that dividends have exact same nature as expenses. So the debit is the side where they increase, and the credit is the side where we record any kind of decrease in dividends. And I think dividends is easy to remember because it starts with the letter D, very similar to debit. So it's an easy way for me to remember that dividends, they are recorded when they increase on the debit side. So again, the debit and credit rules for recording dividends are based on the effect of dividends on stockholders' equity, which is, by the way, we're relating it to retained earnings because dividends have an impact on retained earnings, which is part of stockholders' equity. The next thing that I want you also to be aware of is what we call it the normal balance. And I maybe use the term or the expression, it's like a slang that I said, the preference, the preferred side. And the more accurate language was to use normal balance. So assets, liabilities, stockholders' equity, revenues, expenses, and dividends, they have a normal balance. And the normal balance is usually in the side where they have the increase side or the plus side. So the sum of the increases in an account is usually equal to or greater than the sum of the decreases in an account. In this case, in other words, the normal balance of an account is either a debit or a credit, depending on whether increases in the account are recorded as debits or credit. So the next slide here, I think this should be your best friend. So you should go to the textbook, and I want you to make sure that you understand this very well and stress on it, memorize it, because this is going to be very helpful for you in the future. You need to know that the normal balance are the ones that are highlighted in blue here, or baby blue. So you see assets, liabilities, and equity here, what we call it the accounting equation. And as we said in chapter 1, stockholders' equity consists of two kinds of accounts, which is common stock and retained earnings, which are basically, when we combine them together, we call them stockholders' equity. So assets, the normal balance is the debit side. See where it has the plus sign. Liabilities, the normal balance is the credit side. Same thing for stockholders' equity accounts. The normal balance is the credit side. So wherever we see the plus sign, we know that's the normal balance. Now let's look at the income statement accounts. We have revenues and expenses. Revenues and expenses, revenue, they work in the same direction as equity, and that's why the normal balance is the credit side where we have the plus sign. For expenses, the normal balance is the debit side where we have the plus sign. The last thing is dividends. Dividends also works very similar to expenses, so the debit side is the normal balance. And this is where they have the plus sign. So please make sure that you remember this. I want this to be like your best friend for this chapter. If you can print it out or have it or write it down in your hands, I think practice makes perfect. And one of those things that I learned about accounting, it's like learning foreign language. The more you practice, the better you're going to get at it. And don't just assume that you're going to look at this chart and understand it. I think you have to work with a pen and a piece of paper and try to practice these examples. I'm going to skip this checkup corner. I'll leave that for you to work on your own, and it's not too challenging. And now let's talk about something very important in accounting, which is journalizing. So what is journalizing? Journalizing is the first step where we record a transaction in something called the journal. So using the rules of debit and credit, transactions are initially recorded in a record called a journal. Okay, some people have their own journal or a diary. In businesses, we have a journal. The journal, this is where we record transactions, and they have to be recorded using the debit and the credit language that we just learned. So transactions are recorded in the journal using the following steps. I'm really not a big steps person. I'm not a big fan of like going over steps. I think practice makes perfect, but I'm going to read it anyway. So the first step is that the date of the transaction has to be entered in a column called date column. And then the second step, the title of the account has to be debited, or to be debited is recorded on the left-hand margin under the description column, and the amount to be debited is entered in the debit column. Then we do the same thing for the credit account. And then in step number 4, a brief description may be entered below the credit account. And the last step, the post-reference column is left blank when the journal entry is then posted to something called a ledger. And we'll get to that. I know just going over the steps like that won't make any sense, but once we start recording a journal entry, we're going to understand how this works. But the first thing I want to remember, there is something called a journal, which is where we record the transaction. It's called a journal. Then we have something called journalizing, which is the process. And we also have something called the journal entry. So the process of recording a transaction in the journal is called journalizing, and the entry in the journal is called a journal entry. So 3 important terms I want you to remember: the journalizing, journal entry, and the thing that we record in is the journals. In the good old days, the journal used to be a book where we record the transactions manually. Now everything is electronic. On the very small level, we can use an Excel sheet to record our journal entries, or we go through the journalizing in the journal, which is an Excel file. But again, in the good old days, it used to be like a book where they record the transactions. So let me stop here, and in the next video, I'm going to be going over the transactions.